So I have worked on Wall Street my entire career, and at this point, starting in 2001, it's almost 25 years coming up. Of those quarter of a century, I have spent 20 of those 25 years at a hedge fund, either my own or working at a hedge fund belonging to a bank. But as a result of the experience, I know everything there is to know about hedge funds. So in today's episode, let's talk about hedge funds, as to what a hedge fund does, how is it different, whether you should be investing in a hedge fund, or who should be investing in a hedge fund more specifically. Hi, this is Shalabh Garg, Finance Dad. I have a job at a bank. I've had a job at a hedge fund. I currently run my own hedge fund, and today the episode is going to be all about hedge funds and the lucrative nature of them. I mean, you already know that hedge funds pay very well, right? You've heard names like Citadel, Millennium, and interviewing like hundreds and thousands of candidates for like 3 jobs for the summer, and then the people that do get hired, they're getting paid hundreds of thousands of dollars for just starting out of college. So you've heard the narrative around them. It's not the word probably is not new to you. But what has changed over this period that I've been involved in hedge funds is that the asset class, which used to be a lot more entrepreneurial, has become a lot more institutional, which is to say that big 4 or 5 large hedge funds have accumulated a lot more assets. It used to be the case when I started out that random kids would put up shop, start their own hedge fund, and try to show their talent of investing and raise assets. Now those kids start to join what is known as multi-PMs, and more about that later. To start with, what is a hedge fund and what differentiates a hedge fund from any other way of investing in money? Of course, you know about ETFs, and you know about mutual funds, and you know about Vanguard, and you know about Roth IRA, and you know about PIMCO and VAMCO and all these other big companies. But you may not have heard of names like Millennium and names like Citadel. Probably you have at this point because they've become very famous. But for the longest time, nobody had. You may not have heard of a name like Jane Street or any of these large hedge funds. What differentiates a hedge fund, simply speaking, from any other way of investment vehicle is pure and simple leverage. Whereas most people in the world take $100 of assets and buy take $100 of capital and buy $100 of assets using that $100 of capital, a typical hedge fund will take their $100 of assets and buy at least $300 or $400 of assets. So where do they get that extra $200 or $300 from? They borrow it from the banks. Banks such as JP Morgan and Citigroup and Goldman Sachs. Now, why banks are not their friends? So why do they go on and lend them that money? Because they hold collateral against it and charge interest on it. And that is ultimately the biggest differentiating factor between a hedge fund and any other investment vehicle. There's a second one as well, where the hedge fund can actively short as opposed to just play a security from the long side. But more than the long and the short, because a lot of other managers today can figure out other ways of shorting as well through options and so on and so forth. To me, the biggest differentiating factor is simply the leverage. Leverage works very beautifully on the way up and very destructively on the way down. If you buy something for 100 and sell it for 200, you make a $100 profit. But if you buy something for 100, but use only 10 of your $100 and 90 is borrowed and sell it for the same 200, you made a $100 profit on 10. Thereby massively exasperating your entire profit by a multiple of the original amount. And if you're charging a 20% incentive fee, that is very, very special to hedge funds as well. They are the only investment vehicle in the world that charges what is known as an investment fee. What is an investment fee? Most people and managers charge a management fee. Everybody knows that. People hate fees, but everybody charges them. You buy an S&P 500 ETF, it'll be a very tiny fee, but it will be there, 20 or 25 basis points. You invest in a high yield fund, it'll be a little higher, 1%, but there will be no incentive fee. Hedge funds are the only investment vehicle in the world that charges what is known as an investment fee. How does an investment fee work, and why is it important? An investment fee works as simply as this, that of the profits that the hedge fund generates, it takes 80% of it and gives it back to you and keeps 20% as fee. And in the example that I gave you, where you bought something for 100 and sold it for a 200, but you had only $10 of your own money, the profit was $100 on 10, right? So you made $90, $100 of profit, and you took 20 of it as fees and gave 80 of it to the investor. So think about how much fees that is in proportion of the total AUM that you had to begin with. On $10 of AUM, you generated $20 of incentive fee. I took a very big leverage example because in the example that I gave you right now, leverage was 10:1, which is at the higher end of anyone using it. Most hedge funds don't lever up that aggressively. Most of them lever up 5:1 or 3:1 or 4:1. Even so, you get the idea that when you're levering up initial capital and investing it at a multiplied with a multiplying effect, and then you charge an incentive fee on the profit generated, then on very small of AUM, you can generate a lot of incentive fee, thereby making you hundreds of million dollars of fees. And generally, the number of people working in the hedge fund industry is under 5,000 worldwide. So it's not a very big industry, even though the industry manages in aggregate $4 trillion. That's the amount of assets managed by hedge funds entirely, including all strategies. But on $4 trillion, the number of individuals involved in it, that includes not just the investment professionals, but also includes support staff and back office and middle office and marketing and business development, is under 5,000 people. So it's a very tiny set of people that are involved in the industry. That's why nobody knows about them. And hedge funds are, as opposed to tech billionaires who love to talk about their billions and talk about their homes and yachts and this and the other, hedge fund guys are actually very, very discreet. The reason they're discreet is because, one, they're nerds. Then none of them is sort of entrepreneurial in the way a tech founder is. So they're nerds. They don't want to be advertising their strategy or talking about it. Second, they want to just be discreet about their strategy itself. If they've figured something out that can consistently make them investment return, then you want to protect that IP. You don't want to advertise it, because if you advertise that IP, everybody else will know it too, and your edge is all of a sudden gone. So that's what a hedge fund does, and that's how a hedge fund makes money. So thus far what I've covered is what a hedge fund investment vehicle is and what differentiates it from other investment vehicles. And once again, the primary thing that differentiates it from any other investment vehicle is the existence of incentive fee and the leverage. Both are locked at each other at the hip. The reason they can charge an incentive fee is because they make the case that they're providing leverage to the investor. That leverage, by the way, on your own is not that easy to get. You may think, oh my God, leverage, why is that such a big deal? But think about it. Let's say if you have just your personal capital to invest, let's say $100,000, right? Not a big amount of capital, but not tiny as well for an individual. And you're investing that 100 grand. How are you going to get that leverage? Let's say you want to use that 100 and you really think you have a great investment idea and you want to invest it as 500. It is not that easy to get that leverage. Nobody's going to lend you the 400,000 as an individual. So while I stated very simply that the hedge funds provide leverage, that leverage is a valuable thing to have and a hard thing to get outside of this investment vehicle, which is a hedge fund. Not impossible. There are other ways to get it too, but a hedge fund vehicle provides it, and for that they charge incentive fee, and that's what differentiates them from anyone else. That brings the question, who is the person that should be investing with hedge funds? So for many, many investors, hedge fund will look and feel more like a compensation scheme than an investment vehicle. And the reason I say that is simply because if you're an individual, even not an ultra high net worth, but somewhat high net worth, the amount of fees and in and out fees to the intermediary who invests into the hedge fund on your behalf, or the incentive fee, the management fee, all of that will add up to so much that it'll always feel to you that whatever profits the fund is generating, half or more than half of those profits, they're keeping as fees. And only half of it is coming back to you as an investor. And net of all those fees and expenses, your return is not that much better from the available alternatives to you, which is S&P 500 and other simpler securities. And you're not wrong in thinking that. And in my opinion, I would strongly discourage you, if you are an individual investor, to invest in hedge funds. In my opinion, hedge funds are best suited for institutional investors, for pension funds, for large investors who are already very exposed to the market of S&P 500 or the equity market overall. In other words, most of the pension funds in the country, or even endowments in the country, the typical mix of assets that they have is that they half invested in equities and half invested in some kind of government bond market. That's a typical portfolio. So in an environment where stocks may be doing very poorly, their hope is bonds will bail them out. And in the environment where bonds may be doing growth environment, their hope is that the equity market will bail them out. But there's always these environments like 2022 or other such environments where, because of a crisis, equity market is down so much that they're taking significant hits on their portfolio. And for that reason, they seek out hedge funds. Uncorrelated investment return, late single digits to double digits. 10% is a holy grail. If a hedge fund can provide consistent 9 to 10% net of all fees and expense return to their investor, they're very, very happy with that. Those institutional investors are very happy with that. And these investment vehicles are best suited for those investors because they can negotiate, they can do the due diligence, they can hire intermediaries who can do the due diligence for them to figure out what the best hedge funds are for their investment needs. I think as retail or even as high net worth but not ultra high net worth, these investment vehicles are not the best ones for you. For you, for someone who is high net worth, I would say there's plenty of opportunities available in more simpler investment vehicles with a lot more liquidity. A typical hedge fund will offer liquidity terms that will blow your mind away because they will offer liquidity over the course of 1 year or 2 years, where if you give notice today, your money will only be out at the end of 12 months from now, which, for a pension fund, they don't care because only a very tiny portion of their entire net worth is invested in the hedge fund product, whereas for you, that liquidity may matter. So hence, for me, in my perspective, the best kind of investors for a hedge fund who should seek out hedge funds and already do seek out hedge funds are institutional ones. Similarly, the sovereign wealth funds, such as Sovereign Wealth Fund of Singapore, Sovereign Wealth Fund of Abu Dhabi, all these are big investors in hedge funds because they can afford to. They have the time, they have the energy, they have the wherewithal to do the due diligence to invest in these attractive but complicated, complex investment vehicles, offering tons of leverage but tons of downside as well. Coming from someone who has been his entire career at a hedge fund, it may sound like I'm discouraging you from something that I have done. But it also means that I have a lot of experience with having seen investors. I would rather have a long-term relationship. I don't want someone to join today and then regret their investment decision within a 6-month or a 9-month period because they didn't know about it ahead of time. And that is sort of what I'm trying to educate you for. Of course, I offer a consulting hour, and this topic is very close to my heart. So use the box below to reach out to me. And I'm very happy to help you devise your own investment portfolio and whether a hedge fund vehicle fits well into it. And if it does fit well into it, what kind of hedge fund would fit well into it. We can talk about it all you want. I know everyone, all the investment vehicles within the hedge fund complex that exist. With that, this is Shalabh Garg signing off. Please like, comment, and subscribe to my podcast. I'm trying to grow it, not as much as my wife, but I want to grow it too. With that, signing off. See you next time.